Hi, everybody. This is Dan Sheridan, Sheridan Risk Management. And today I'm just going to share um, 4 execution tips for option trades in a volatile market. For about 20 years, 22, 23 years, I was a market maker and specialist at the Chicago Board Options Exchange. And the last 20 years, I've been teaching retail traders uh, option trading, risk management. And so I wanted to share a few tips in the current volatile market uh, that we're in a little higher VIX environment, just some tips that might help you as you're trying to get good execution in a volatile market. Number one, mid-price versus mid-range with debit and credit spreads. When you talk about mid-price, there's no such thing as mid-price. There is no mid-price. If you watch the mid-price, uh, for more than 30 seconds, it might change 8 times. So there's a mid-range. And so if I'm doing a credit spread, I might watch the range for about 30 seconds, get an idea. Okay, the credit's gone from $2 to $3, even though it looks like most occurrences might be at 230 or 240. Start in the top end of the range for a credit transaction and slowly, every 20 seconds, lower it 5 or 10 cents in the SPX or whatever vehicle you're looking at. Some vehicles, if it's a cheaper stock, um, $100 stock or $200 stock, that's going to be different than a $5,200 vehicle like SPX is now. So I think that's important. If it's a debit transaction, watch the mid-range. Where is it trading for a minute or so? Start at the lower end of the range uh, with a debit and slowly work your way up and then get filled on one. Even if I'm going to do 4 or 10, I'll start with one because I want to see where is fair value. Number two, limit orders to enter and exit trades. Um, I think it's you definitely anytime you have a trade on, always have a limit or have some kind of limit order in to get out of it, even if it's away from the market. Put a good till cancel order in because you have a broker working for you for free. You have this order in, and a lot of times, you know, you think, well, I wouldn't have got filled. Well, you don't know unless you have an order in, right? And so it's always prevalent to have an order in. For a limit order, you may get one shot at it, right? Whether you're trying to make 10% on a range bound trade or 30% on a spec trade, uh, it doesn't matter. You got to have an order in. And I think, limit orders are pretty good. Number three, um, market orders. There's a lot of talk about this very strong opinion. Some people say, never do a market order, or I would do a market order, or I wouldn't do a market order. My thought on market orders, I generally wouldn't. I generally try to maybe set an alert and do it myself, right? Um, that would be the key. But let's say you're busy or you're at work, you can't look at a screen. Some brokerage firms can have an order in, you get out at mid prices plus 10 cents or whatever. But now you say, Dan, the market has been crazy in the last month. What could you do? Well, there's only a few vehicles that I would feel comfortable with a market order. I mean, SPY, maybe a really liquid stock like Apple or Nvidia, maybe Tesla. Um, I'd rather not do it, but I'd rather have a market order in a very liquid stock and make sure I get it versus having a limit order that never gets filled, right? And then so market orders, I'm generally not favor of them. But again, the key is the key is the vehicle, right? I mean, there's some vehicles you can go in, they're not really liquid, and you could get torched on a market order. Go against number four, go against the flow for better pricing. What does that mean? In a volatile market, things can move up fast, move down fast, big minute candles, or these candles are going quick. So if you ever notice, let's say I'm looking at doing a call credit spread and the market's going down. And because the call credit spread is going to be a little bit short delta. So we're going down because the market's going down. I'm trying to sell it for $2. Uh, now the market's going down. It's a little short delta. It's $1.90. It's $1.85. And I'm chasing it, right? I'd rather go against the flow for better pricing instead of trying to get it when it's going down on a short delta trade like a call credit spread. When it's up in the range I want to do it when it's coming up. I think you could save 20 cents that way, 25 cents, because get it when the fever is we're going up, have, have a limit order or sell it, because once it turns, it's more difficult, right? Similar with let's say a put credit spread. The market's going down and you can see the price, put credit spread at $3. It's $3, 3.10, 3.20, because the market's going down. If it's in your range or where you want to sell it from a price point, you're going to get a better price. Once the market starts going up and you're trying to do a put credit spread, which is long deltas, now it's a little tougher. The market makers are seeing the market starting to recover. They're not going to give you a really good price on it. So another way of saying this is, if you said to me on a call credit spread, which is a little bit short deltas, if I go in and try to do a call credit spread, is it easier to get mid price kind of when SPX is going down or going up? It's much easier if SPX is going up and I'm trying to do the opposite of the flow. I'm trying to do a call credit spread, right? You're not going to pick the top, but as it's going up and I sell the call credit spread, I can easily get mid price, right? I can get better than mid price because the market makers and the customers are, hey, the market's going up, they're going with it. But the minute the market turns and we start going down, depending on how fast, obviously, if I try to do a call credit spread, it's tougher to get mid, right? While it's going down. If the market's kind of quiet at lunchtime, it shouldn't mean as much, but just with the market going fast. Now, another thing, just a bonus execution tip, since I'm too lazy to put 5 execution tips. And this happened to me last week. We're human beings and we're going to act like human beings more than we would like to in terms of especially execution. So you go on your brokerage platform and the adrenaline's flowing, the market's busy, maybe you're in trouble on a trade, you got to get out of it, or you think, hey, this is a good price to get in this trade. Market's going up, I want to buy some puts, I think we're going back down, blah, blah, blah. So you put an order in, you hit the send button, and then you think, oh, geez, I just did 10. I only wanted to do 1. Or I did puts and I wanted to do calls. Or I did a different expiration. So again, my rule is, and when I don't follow it, it doesn't go well, is before I hit the nuclear weapon button and hit the send button on the brokerage platform, read the order. Read the order to yourself. Look at the commissions. And what are you looking for? Contracts. If you want to do 1, make sure it says 1 and not 10. And you could put a default on there. Number 2, check the duration. Number 3, check the strikes. Check the debit and credit. Is that the debit or credit you wanted to do? Check the commissions. And when you pull up that tab, you can do that, right? Like different brokerage want to say confirm and send. Well, I click, I can confirm, I can go through all the information, then hit the send button. So here's some little tips that you can do when the market is a little more volatile that can make life a little more easy for you. If you have any questions, I'm Dan at SheridanRiskManagement.com. Check out our courses, check out our daily classes at Sheridan Risk Management. Have a great day, everybody. Appreciate it.